Okay, folks. I'm sorry if you haven't got your valuation back. I had 407 valuations overall. I've returned about 250, I think. So I have like 157 still waiting in my stack. So I am grading quizzes today, so I won't get to them. But sometime soon, you should get your valuation back. And if you looked at what you got as feedback, it's not mind-boggling, right? Basically, I look at your revenue growth, your margins, your reinvestment, and I say, you know what, this looks okay. This you might want to test. And that's all you're going to get as feedback. And so if you're expecting magical things, I would stop expecting them because I don't know more about your company than you do. But today we're going to kind of almost wrap up what's left of intrinsic valuation. And one of the things we're going to talk about is why valuing banks is so problematic. Okay. Is anybody familiar with what regulatory capital at a bank is? Will you tell me what regulatory capital at a bank is? Give it a shot. And who sets that regulation? Well, in the case, it's a bank regulators set, and why do they set that? So bank regulators set a regulatory capital ratio. You got to maintain at least that capital. Yeah. To protect depositors, right? Basically, banks, unlike every other company, you can't just say, just go bankrupt, right? Because a tech company goes bankrupt, it might take a few people in Silicon Valley down with it and push down housing prices in San Francisco, but it's not like the rest of the world suffers. But if a bank goes down, it takes down depositors. Have banks always had regulatory capital requirements? You nodded no. What created regulatory capital requirements for banks? You got it. Until the Great Depression, banks self-regulated. What does that mean? They set aside enough capital to cover a bad year. I mean, the Rothschilds have had banks for what, 600 years? They've run banks without regulatory capital. So banks have always needed that buffer. But after the Great Depression, the government said, we can't leave it up to banks to do it. There's a regulatory capital requirement. So what the bank regulator specifies a minimum regulatory capital, and that regulatory capital is usually defined in terms of equity, because you need equity to cover the runs. So think of regulatory capital loosely as book equity. So banks, unlike traditional companies, has required book equity. That's a minimum. So let's say the minimum is 15%. You need to maintain a 15% regulatory capital ratio. Are banks allowed to keep more regulatory capital if they want to? Yeah, you could be a conservative bank and say, I'm going to keep an 18% ratio. Why would you want to do that? What causes regulatory capital to change from year to year? One is losses. You have a big trading loss that comes out of your regulatory capital. So you might say, look, I don't want to be right at the margin because then I'm one shock away from going under. So some banks are conservatively capitalized. Some are aggressively capitalized. And can a bank be undercapitalized? It happens. In which case they're under pressure. They need to bring their regulatory capital back up. So here I'm going to give you a story about a conservatively capitalized bank. Okay? So its regulatory capital ratio is set well above the regulatory minimum. Tell me how this is going to play out in the numbers you see for the bank, right? Because as a bank, you're looking at it as an investor. One of the things we're going to see with banks is the return equity becomes a big deal. If you have a high return equity as a bank, you're a better bank. And then you look at the risk of the bank. So if you have a conservative finance bank, it has too much regulatory capital. How is that going to play out in your return on equity for that bank?
Low return.
And tell me why.
Investing as much capital.
Because or your more book equity, right? For the same net income. So your return equity is, which is by itself a bad thing, but you'll also have less risk, lower cost of equity. Today, we're going to talk about connecting return equity and cost of equity to how your bank is capitalized. So if you're not familiar with regulatory capital, don't worry. It's not a steep mountain to climb, at least in the outside. So we'll talk about how regulatory capital plays out with banks. After we do that, though, I want to take a final question. So some of you found your stock to be undervalued. I haven't kept the statistics yet, but towards the end of the class, I'll actually show you what the distribution of what percentage of the people in this class found their stock to be undervalued and overvalued. And I'll show you what that statistic has looked like for the last 30 years that I've taught this class. So you can see the number go up and down. But some of you have an undervalued company. So let's say that you believe your valuation. Absolutely, you think your value is right and your stock is undervalued. Would you put 100% of your money in your stock? Why not? Let's say you're right about the value, right? So you feel certain that it's undervalued. What are you uncertain about? The part you don't control is when will the price adjust to value? One of the things we're going to talk about is concentration versus diversification portfolios and how your uncertainty, not just about your value, but about how the market will correct its mistakes, is going to play out in how many stocks you end up with in your portfolio. So let's go back to where I left you on. After the quiz, you were probably shell-shocked. You weren't even thinking. And incidentally, a lot of you haven't picked up your quizzes. I don't care. I'll just throw them away at some point in time. But you might want to pick them up at some point in time just to check the grading. So if you remember, we were talking about Hormel Foods, right? We talked about the debt ratio being too low. And many of you valuing companies with the debt ratio is tiny, 2%, 5%, 7%. You're probably saying, why don't they use more debt? And at first sight, using more debt looks like it should lower their cost of capital, right? Your cost of equity is usually much higher than the cost of debt. So the general conventional view is increasing debt ratio should lower your cost of capital. It's not that simple. And here's why. When you raise your debt ratio, you are replacing more expensive equity with cheaper debt. That's the good news. But when you raise your debt ratio, tell me what else is going to change. What's going to happen to your cost of equity as you raise your debt ratio? And tell me what mechanism there is in our processes that makes it go up. And what input into the cost of equity is going to change, reflecting the fact that you have more debt. There are three numbers. I'll give you the three. Tell me which one is most likely. There's a risk-free rate, which will that change? No. An equity risk premium. Well, I thought that's coming from the market, right? That's a market price. And what's the third number you need? Risk-free rate, equity risk premium, and this is why we lever and unlever betas, because when you change the debt ratio, I'm not going to give you a free lunch. I'm going to say, okay, you've replaced more expensive equity with cheaper debt, but your beta will go up. Here I've taken Hormel Foods, and as their debt goes from 0% to 90%, your beta goes from an unlevered beta to a supremely levered beta, beta 5.39. As the beta goes up, your cost of equity goes up. So your debt ratio changes, your cost of equity will go up. What about the cost of debt? What's that driven by? Risk-free rate plus, Daisy? default spreads for the company and the country, right? The country you don't do much about, but as you borrow more money, what happens to your default risk as a company? It increases, so people charge a higher spread, so your cost of debt will also go up. And that's what I've done here is as the Hormel's debt ratio goes up, I've estimated what their rating will be. Remember that synthetic ratings process with the interest coverage ratio? So as their debt ratio goes up, their rating goes from AAA down to double C. So if I did a leverage buyout, and remember in a leverage buyout, you go to 90% equity, 90% debt, 10% equity, the beta will go through the roof and so will the cost of debt. You take a weighted average of the cost of equity and the after-tax cost of debt, you get a cost of capital. So when I go from 0% debt to 10% debt, my cost of capital does go down. So the intuition is right. Debt lowers your cost. You go from 10 to 20, it continues to go down. And then once you get to 20%, it kind of levels off, right? It goes a little bit down when you get to 30%, but around 6.59 or 6.57%, it levels off. And if I keep pushing the debt ratio up, my cost of capital starts to go up again. In my corporate finance class, which I don't teach, the undergraduates anymore, I teach the MBAs, we go through an optimal debt ratio for a company. This is what we do. It's not rocket science. You have the mechanism to do it. You can compute the optimal debt ratio. The reason I bring this up is, let's say you take your company and say, what if they borrowed more money? You can't just lower the cost of capital. You got to go through this process of what will happen to their cost of capital if they use more debt. And the effects are unpredictable. If you're an underlevered company, raising debt ratios will lower your cost of capital. Yes.
The last slide, explain why the tax rate.
That's a good question. I forgot to mention that. Why do we multiply the cost of debt by 1 minus the tax rate? And how does that tax savings work? Does the IRS mail you a check for the tax? It doesn't, right? You have to cover it with income. You know what's happening once I get to 80% and 90% debt ratios? My interest expense exceeds my income. So basically, I'm saying, hey, you borrowed so much money that you've lost the tax savings. So the lowering of the tax rate is a bad thing here because it means you've lost some tax savings. You don't have enough taxable income to cover it for this specific company. But in another company, I mean, if you take NVIDIA at a 30% debt ratio, they'll go bankrupt. Why? Because you have $2 trillion, right? 30% of 2 trillion is 600 billion. You compute the interest expense on that, you're done, right? You don't have the income to cover it. So where you hit that tipping point will vary depending on the company. But once you hit the tipping point, I have to be realistic in saying you've lost the tax benefit. Let's talk about the last stage in the life cycle. Most depressing valuations are valuing companies that are in decline and distress. Somebody in this class is valuing WeWork. Are they here today? They were in my office earlier today. They've chosen not to be here, which is probably because they're in shock. And my first reaction is, why would you value WeWork? It's already in Chapter 11, but let's face it, there are companies out there that are in trouble and you still might want to value them. Let's think of the challenges you face when you value a declining and sometimes distressed company. You ready? You have a declining company. Take any brick and mortar retail company outside of perhaps Walmart, Target, and Costco. You're pretty much every other brick and mortar retail company. You're looking at a pretty bleak future, right? When I look at my historical data for the company, what am I going to see? I'm going to see depressing things. My revenues are shrinking because people are not coming into my stores. My margins are under a pressure because there's a lot more competition. So my margins are going down, my revenues are shrinking. So my cash flows look bad. Then I ask you, what is the value from future growth? If you're a brick and mortar retail company, what's your reaction? What future growth? You're looking at a future that's shrinking, so your growth rate can actually be a negative number. And if you have a negative number, the question you're asking is, what am I divesting? Your reinvestment is not reducing cash flows, it's getting money out of your assets. So you'll see negative reinvestment, negative growth rates. And ask you, how risky are you as a company? You're shrinking as a company. And if you're not careful in paying off your debt ratio is going to rise over time because you have a smaller company in the same amount of debt. You could be in distress. And when I ask you, when will you be a mature company? What's your answer? It was 20 years ago. That's like going into a senior center. Say, when will you be middle-aged? You'll probably be beaten up by old people saying, are you trying to abuse me here? You're a brick and mortar retail company. You were a mature company 20 years ago. You're now in decline. You might not make it to being a mature company. In fact, your steady state, you might be looking at liquidation. It's not, financially, it's not difficult to value a declining company, but psychologically, it is really, really, really difficult. In fact, when I run into people who do valuations for a living every day, they've been doing it for 30 years, I ask them a very simple question. Have you ever valued a company where you put in a negative growth rate on revenues? You know what? Most of the people in that room, 95% of people have never done a valuation with a negative revenue growth rate. And I said, that's weird. Because when you look at the real world, there are companies that shrink. How come you never run into these companies? The answer is they do. But as human beings, what do? You override. And some of your valuing companies are in decline, and what you've chosen to put in, because it seems so unnatural to put in a minus 5% growth in revenues for the next 10 years. But the reality is that is what you might be facing. So let's say you're looking at a declining company, the business is shrinking. There are two scenarios you have to worry about. And the first is this company is run by people who are realistic about being a declining company. So if you're the CEO of a company in decline, what should you be trying to do? Make your company smaller, liquidate your company over time, and go away. You know how difficult this is to do again? Because as a CEO, what do you try to do? You try to rescue the company, you try to rediscover growth. That's a scenario where, as an investor, I'm terrified because you're going to be putting more and more money into the company trying to make it grow. My money, not your money. And in the process, you're going to destroy value. When I valued Yahoo in 2015, this was my point about Marissa Mayer. Those of you who don't remember, Yahoo hired Marissa Mayer from Google. She came with this great reputation of being a tech company manager who knew what to do. And she was given a task. Yahoo is a shrinking company. People are not using our search engine or our mail program. Do something about it. And she tried. She bought Tumblr for $1 billion. She did about $5 billion worth of acquisitions. But the problem is 3 years later, Yahoo was dead as a company. It was $5 billion poorer because she tried to make it grow. So valuing a declining company, when you ask about, is my management a good management? You're hoping and praying the people who run this company have never taken a sustainability class. Because what do sustainability classes teach you to do? Preserve and grow companies no matter how terrible they are. That's my main problem with sustainability as a word. Is I can understand taking a healthy company and want to make it sustainable. But taking a company that's in a bad business and trying to make it sustainable makes no sense at all. So here's what I'm going to do. I'm going to value a declining company, potentially distressed, a company called Bed Bath and Beyond. Have any of you been in a Bed Bath and Beyond store? It's a pretty depressing experience. It's kind of mind shifting. You walk in and say, what the heck do they sell here? When you looked at the title, Bed, Bath, and Beyond, maybe the Beyond should have given it away. You think about bed sheets and house. You walk in there, this place is like a gadget place. So you walk in, you could come out with things you never wanted in the first place. But for a while, this was a great concept. People loved it. Now, I used to, live in a part of New Jersey, which was 3 miles away from the original Bed Bath and Beyond store. It's like a religious experience. I guess you visited to see what it looked like. And for a while in the 1990s, it soared. It was a high growth retail company. And then it fell on hard times. In fact, this was a valuation of Bed Bath & Beyond I did in September of 2022. And to set the table, here's what it looked like. It had revenues of $7.9 billion. You're saying that's not bad, but that was down from almost $12 billion just 5 years ago. Revenues had shrunk. Their margins were minus 1%. They were losing money. They used to make money. So clearly the company's under pressure. Fewer people are coming into the stores. They're having trouble making money. So I said, look, I'm going to try to value the company. And I have to tell a story. And remember, the stories you tell in valuation are not always uplifting fairy tales. The reality is the story I'm going to tell you about Bed Bath & Beyond is going to be a depressing story. It's going to reflect where it is. In my story, I see Bed Bath & Beyond continuing to shrink over time. They're going to shut down stores. But here's the optimistic part of the story. I think that
they shrink enough, there will be a core set of stores. There are still people who like going to Bed Bath and Beyond. I don't know why, but there are people out there. There's this core audience. Maybe if they got smaller, they can cater to that audience. So in my story, the company is going to shrink over the next few years and become a smaller and more sustainable company, a company that can actually grow, but it's a smaller company. So if you look at my revenues, they start at 7.9 billion. By the time you get to year 10, they're down to 5.9 billion.
Once I get to 5.9 billion, I'm assuming that they've hit this point where they can now go back to being a mature company. Does that always have to happen? No. I could have had in my story the conclusion that at the end of year 10, the entire company shuts down, and I liquidate my leases, and I get that as my terminal value. Okay? So in my story, revenue shrink. Here's the upbeat part of my story. Those losses are going to turn to profits. And here's what I'm hoping will happen. When you think about, Bed Bath and Beyond shutting down stores, you're going to start with your least profitable stores first, and you're going to work down. So there used to be a Bed Bath and Beyond on 18th Street, I think, on somewhere around here. That's probably a store that lost a lot of money because the lease is a very expensive lease. Those are the stores I'm going to close first. So my hope for improved margins come from the fact that I'm removing the least profitable stores from my mix. Again, that is the upbeat part of this downbeat story, is that over time the margins will improve. You're seeing why to 5.54%. I noticed many of you, when you gave me, you projected improved margins in the future, and you threw in the usual buzzword. There are economies of scale. You used a lot of economies of scale to justify things, and I'm okay. That's a good word. No? But when you give me a target number, your story has to also explain why the 14%. So I'll tell you why I picked the 5.454%. That is actually the 25th percentile of operating margins for retail firms in the US. So basically, they're going to come back to profitability, but it's going to reflect the fact that they're not going to be at the top of the heap. So it's going to come back to that. So over time, my revenues shrink, my margins improve. And then you notice my reinvestment is negative for the first 7 years. What does that mean? As I'm shutting down stores, I'm hoping the owners of these spaces are paying me to go away. Right? I'm getting out of leases. They want to lease it to somebody else at a higher price. Might that not happen? Yes. If you believe that you will not be able to get any cash flows when you shut stores down, you know what your reinvestment should look like? Just put in zero. You'll have much more negative cash flows because of that. That negative number reflects cash that you're going to get as you close these stores down. So over time, my cash flows improve as my stores get shut down and my margins show up. I'm going to discount them back. The value per share that I get. And one of the nice things about valuing declining in distressed companies is all those restricted stock and options you gave have become worthless. So you value the options, you get nothing because the exercise price much higher. The value per share that I got was $3.23. September 22, the stock was actually trading at 8.79. Sachi?
About like kind of shutting down and shrinking the business, do you think that's actually reflective of what you think the like C-suite at Bed Bath?
That's a good question. I mean, did you read the GE article about what CEO of GE has been doing? Culp has been doing. So, in fact, it was a story. I'm not sure it was a complimentary story, but the Wall Street Journal was talking about how he was shrinking this great, amazing company that had been built up over 150 years. And my reaction was kudos to him. He was doing the right thing. I wish somebody had done this 10 years earlier. So it is difficult to find CEOs for declining and distressed companies because, and I'll give you who you want running your company in decline or distress. Have you seen Other People's Money? It's a movie about an activist investor who takes over an established company and shuts it down. You know who plays the activist investor? Danny DeVito. You want Danny DeVito running your company, saying, look, I'm going to get the cash out here. I don't care about this growth stuff. But the problem is we don't celebrate those CEOs. We celebrate empire builders. When was the last time you saw a movie about a CEO who made his company smaller? I remember the movie about Steve Jobs and all these great empire builders. It is difficult because you're looking for a very different type of personality to run this company. You want people who basically are looking at the numbers saying, this is not going to work. I can't rescue this. But that requires people with low egos, not much ambition, who are willing to do what they came to do.
So in many declining companies, the biggest problem is management trying to rescue these companies and making them growth companies. And there, as an investor, the value is actually going to be lower than 323. The harder I try, the less valuable the company will become, because then I'm throwing good money after bad, and it's not going to come back. Okay. Now, of course, this 323 in hindsight was actually optimistic, because a few months later, Bed Bath & Beyond actually filed for bankruptcy. But at that time, market was much more upbeat, $8, because a new CEO had come in. And this is what I don't understand. When a new CEO gets hired at these companies that are basket cases, what do you think that new CEO is going to be able to pull off? So that's the decline part. Let's talk about the distress part. Distress, in addition to all of the things I talked about, there's an additional problem you face, which is your company might not make it. And the problem with that risk is it's very difficult to bring into a discounted cash flow valuation. What's the input in our discounted cash flow valuation where we reflect risk? What's it? The cost of capital, the discount rate, right? So you're saying, why can't I raise the discount rate if you're a distressed company? Because discount rates were not designed for that kind of risk. They're designed to capture what's called going concern risk. And this is the risk that you will not make it. When you have that kind of risk, the only way to bring it in realistically into your valuation is to keep it separate from your DCF. So when you do your DCF, put your optimist hat on, value the company as if it'll make it as a going concern, and then take that hat off and then ask the question, what is the chance I will not make it? We'll talk about some of the ways you might be able to estimate it. And what will my equity be worth if I cannot make it? You're saying, how the heck am I going to estimate the likelihood that my company will not make it? I'll give you the easiest scenario. If you're valuing a company that has a bond rating from Moody's or S&P, you're well on your way to estimating a likelihood of failure. If you have a company that's double B rated, there's almost a 28% chance your company will not make it. You know how we know that? Because you can go back over the last 100 years, you can track bonds in different ratings classes. Ed Altman, who used to teach you, used to keep this on an update basis. Moody's and S&P do it now. So you can look to see with each rating, what percentage of bonds in that rating don't make it through the next 10 years. A AAA, 0.01% don't make it through the next 10 years. That's why with the AAA bond, you don't worry about distress risk. Triple B, it's only 9%, but you get to double B, single B, triple C, you're looking at 28, 30, 35% chance of failure. If your company is not rated, things get messier, because then you have to estimate the likelihood of failure. I don't know whether you've all run multiple regressions, right? In a multiple regression, you have a dependent variable and you have independent variables. You know whether you've run what's called a probit. Anybody here run what's called a probit? Probit looks like a regression, but your dependent variable takes on a value of either 0 or 1. So let's say I take every publicly traded company in the US in 2020. And then I looked at how many of them failed in the last 4 years and how many of them remained. So I take all the companies that failed, I put 1 next to them and put zeros on the ones that did not fail because they're still around. Then I can look to see what drives failure. If you had a high debt ratio, your revenue is shrinking. It looks just like a regression. When you plug the numbers in, you get a predicted likelihood, a probability that you can then use as your probability of failure. Okay? So basically, you're trying to estimate a probability of failure because in failure, what will the company do? It'll shut down, it'll liquidate, and if there's any money left over, you're going to get it as leftover equity. So rather than talk in abstraction, let me take an example. Know whether you've heard of this company called Las Vegas Sands. Does anybody know what it does? It's a casino company. And I'm going to make a generalized statement about casino companies and, broadly. Take it for what it's worth. Casino companies tend to be run by megalomaniacs. Right? You could take Steve Wynn. In the case of Las Vegas Sands, you know who the CEO of the company was in 2009? A man called Sheldon Adelson. Yeah. Sheldon Adelson owned 52% of the shares. And this is going to be part of the story. He owned 52% of the shares. He had a controlling stake of the company. And he had big ambitions. He wanted to make Las Vegas Sands into the biggest casino company in the world. So through the 2000s, Las Vegas Sands built casinos all over the world. Now, whether any of you have been in Singapore, but they have the Marina Bay Sands in Singapore, this big hotel that looks like a ship. It's a monstrosity.
They have one in Macau, so they kept building casinos all over the world. Now let's complete the story. Have you ever driven by a Las Vegas casino? Have you ever been to the Bellagio? You know how many times I've been lost in that place? You go down the wrong corridor. People might not find you for a couple of years, I think. It's got 26 restaurants in the casino. That's how big it is. What I'm trying to say is you take a casino, this is a huge infrastructure investment, hundreds of millions of dollars. So Las Vegas Sands building casinos, spending hundreds of millions of dollars. What are the two ways you can raise capital to fund these casinos? You can borrow money, or you can use shares. And here's where what I told you about Sheldon Adelson comes into play. I told you he was a megalomaniac and he owned 52% of the shares. You see what the problem is in issuing shares, right? You issue shares and outsiders buy, the 52% could become 51, 50. And this is not good for a megalomaniac to drop below 50%. So guess how Las Vegas Sands funded every casino? They borrowed money, built another casino, borrowed more money. And as long as times were good, people did not notice. So in 2007, people loved Las Vegas Sands. Great growth casino company. And then 2008 hit. And everything got flipped on its head. First, fewer people started coming to casinos because they were all lost their jobs and didn't have money. The second is all the debt that Las Vegas Sands had accumulated over the decade came back to haunt them. So this is a valuation in February 2009. And it was a valuation done in the midst of news stories that said Las Vegas Sands would not make it through the next 6 months. So basically, a lot of stories saying there could be distress and failure in the next 6 months. I shut those stories off, put my optimist hat on, and I fixed the company. So easy to do in a spreadsheet. So if I give you a money-losing company in trouble, a casino, tell me what the things are that you'll fix to make it into a money-making, healthy company. First, you'll have people come back to the casino, so your revenues are going to come back. And as they come back, what will happen to your margins? Your margins will improve, so you'll become a profitable casino. And in the process, what will you do to your debt? You'll pay down your debt and become a nice, I know that's what I did in my spreadsheet. I made it into a nice, healthy casino. 10 years from now, gave it a big terminal value. Nirvana is here. And I discounted it all back and said the value per share is $8.12. So this is a discounted cash flow valuation on Las Vegas Sands recovering and becoming a healthy casino. Is there a chance it'll happen? Yes. Casinos go through these ups and downs. I'm assuming that it'll come back. So I finished the valuation. I actually was doing this in real time and the stock was trading at 425. So ask me the question. It's a question you need to ask to see if I trust my own valuation. Am I buying, right? Now, what is it at is just an abstraction. If I'm not buying, then you're not buying either, right? So that's how you're buying. And I said, no, I don't feel like it, which led to some soul searching, right? If my value is 812 and the price is 425, I should be buying like crazy. And I started thinking, what is it that's holding me back? And what do you think was holding me back? This is the valuation if it becomes a healthy company. And what's holding me back is all these news stories I've been ignoring that they might not make it through the next 6 months.
So I was going to ask, right, how do you make that value judgment about whether it's possible that the company is going to improve versus like, oh, maybe the value is higher than this share price, maybe the value.
The value is the value. Forget about the price. The price part is the markets to do it. In an intrinsic value perspective, I've got $8.12 as my value if the company makes it. To complete the process, I need to answer two questions. What is the likelihood my company will not make it? And what will my equity be worth if it doesn't make it? Let me try. At the time that I did this, Las Vegas Sands was rated B+. What's a cutoff for investment grade bonds? You know? It's triple B, so they're well below investment grade. So the ratings agency is saying, watch out, there's a lot of danger. In fact, if you look at the history of B+ rated bonds, the likelihood of failure given their rating was about 28%. So you could argue that the value that I got was for the 71.75% of the time that they will make it, the remaining 28.25% of the time, they're going to go bankrupt. In the case of Las Vegas Sands, there's another way in which I could have estimated the likelihood of failure. We all know how to value bonds, right? Well, how do you value a bond? What do? You take the promised coupon and the face value, and you discount it back at a risk-adjusted discount rate. That's the way we're taught to price bonds. I'm going to give you a different way of pricing bonds. What if you took the expected coupon? You're saying, what the heck is an expected coupon? I promise you a coupon, but to get the coupon, what has to be true? I've got to be surviving as a company, right? So I took the promised coupons, which was, in this year, a 7-year bond. I multiplied it by the likelihood that I'd be around to pay the coupon, which I don't know yet. So leave it as an unknown. And then if I make it all the way to the end, I'll get the face value back. And because I'm adjusting my coupons and my face value for the likelihood of failure, I could discount them back at the risk-free rates. There's a 7-year bond that was out there that was traded, which had a market price of 529. I said, I know the coupon, I know the face value, I know the risk-free rate. What if I solve for the likelihood that I will not get paid? So it's a solver function in Excel. What I got as my likelihood of failure each year was 13.5%. Just to give you a sense of how big that is, for me to make it to year 10, which is nirvana, I've got to survive 10 years, right? 13.5% compounded over 10 years gives me a likelihood that I'll make it to year 10 of 23%. We're looking at a scary looking number. There's a 23% chance I'll get to nirvana and the $8.12. The remaining 77% of the time, bad things are going to happen to me. I'm going to go bankrupt and then ask the follow-up question. If I go bankrupt, what will I get as an equity investor? So if Las Vegas Sands goes bankrupt, what do they have to do? Auction off their casinos, right? How many of you are in the market for a casino? It requires a few $100 million and moving to Vegas, neither of which I want to do. There's a subset, a very small subset of people usually running other casino companies who are potential buyers. The problem is when you're in trouble, they're all in trouble, which means if I try to sell these casinos, I'm not going to get face value or what I think these casinos are worth. I'm going to get a fraction of the value. For those of you in the spreadsheet, if you remember, you get down below in the defaults, one of the questions I ask you is, what's a failure risk? You can enter 10%, 20%, then ask you, in the event of failure, what are you going to receive for your assets? And I state it as a percent of book value or as market value, but you're not going to receive 100% of fair value. You're going to get below. In this case, I assume that you'd make about half of book value, which is 2.8 billion, which is well below the outstanding debt of the company. Long story short, my equity is going to be worth nothing if they go bankrupt. So I have two values for the company, right? $8.12 if they make it as a going concern, which happens 23% of the time. 0 if they don't make it, which is the remaining 77% of the time. My expected value is not $8.12. It's $1.92 once I've factored distress into the process. So if you're valuing a company like WeWork, this is going, even if you think there's a pathway for them to be a healthy company, you're not going to pay that because there's a very high likelihood that they will not make it there, and you got to factor it in. Any questions? Yes.
The distress sale proceeds of like something.
Well, I'll tell you what, if I'd used even entire book value, it was still out. So in this case, it would have been easy because it's not the proceeds that matters, is will my equity be worth anything? That's really the question, right? If the answer to that is 0, it doesn't matter whether it's 6 billion, 4 billion, 2 billion, I still have to pay off the debt. It's in some cases that liquidation value can be high enough to cover your debt, in which case your equity will be worth something, but it's not going to be worth as much as your discounted cash flow valuation. Okay? So it really depends on the company and what they're trying to sell. Yes. Mm-hmm. Yeah, the question, that's a good question, because why do we do intrinsic valuation? Because we don't trust markets, right? So in this case, you say, I don't trust bond markets as well, then I would say with the rating-based approach, because bond markets might be overreacting. I'll tell you why I trust bond markets on default. Bond market investors tend to be single-minded, right? Will I get paid? Will I get paid? Will I get paid? They don't get distracted by growth and margins, and they frankly don't care. So because of that, I think there's a better shot that the bond market gets distressed right than equity markets do. Okay? But you're right. I am trusting the bond market. If I don't do that, I have to go with the rating. And and this is, so at both ends of the life cycle, this is an issue. We talked about in the context of young companies. If you remember the failure rate,
There, it's very much more difficult to estimate the failure rate because you don't have bonds, you don't have a rating. Here, you have a shot. No. Yes. They do, but usually it's not by, it'll be a notch or two. You'll never see a bond with a double A rating from S&P and a triple C rating from Moody's. No.
How that is finding that rating drugs are not
They're looking financial, basically accounting information, because we know what drives a company into default, right? You have too much debt, you're not making enough money, so they have a bunch of ratios, including the interest coverage ratio. So they look at 8 or 9 different ratios, trying to get a sense of how healthy is this firm and how much is it capable of paying the debt obligations it has. So it's really not rocket science. Basically, it's the same way banks have always looked at credit risk, right? You walk into a bank and you try to borrow money, they ask you for information on your business, your income, your expenses. It's basically what S&P and Moody's do. Let's talk about emerging market companies. Again, let's go through the question. You take an emerging market question in your company and you ask, what are your cash flows from existing assets? What is the value of your growth? How risky are you as a company? And when will you be a mature company? The answers to all those questions are as much driven by the company as they are by the country in which that company is in. Do you see what I'm saying? If you're an Argentine company, when I ask you the questions, I'm much more concerned about Argentina, the country, than the company itself. There's a country risk lurking in the background. So there's no way around it. Right? And that's why we spend so much time talking about country risk premiums, is you got to bring that country risk into your valuation. I don't think anybody would disagree with it. The disagreement is, how do we do it? The way we went through it in class is we try to bring it into the discount rate through a country risk premium. And even there, we used a scalpel, not a bludgeon. What do I mean by that? I take every Brazilian company and give it the Brazilian country risk premium. I looked at where they got their revenues and I looked at a weighted average across the parts of the world. So when you think about country risk, you can have a safe company in an emerging market, or at least a safer company if it gets more of its revenues outside the market. So the way we adjust the discount rate reflects what we think about. Second, it's a point we made earlier when we talked about risk-free rates. You can value any company in any currency. Currency should not matter. That sounds like a weird thing to say. You're probably going to get into arguments about this when you get to work. So what do you mean currency doesn't matter? The risk-free rate in this currency is 8%, in this currency it's 2%. How can currencies not matter? Let's start with the easy part. When you have a risk-free rate of 8% in one currency and 2% in another currency, the cost to capital is going to be much higher in the 8% risk-free rate currency, right? That's the bad news. The good news, though, is the risk-free rate is higher in that currency because inflation is higher. So when you do your valuation, your growth rate should be higher if you pick the higher inflation currency. Whenever I say this, so people don't believe me. So the only way to convince people that currency doesn't matter is to actually value the company twice. So I'm going to show you a valuation of a company I did. I don't know, remember when I valued Infosys. Infosys is an Indian outsourcing company. It's one of the biggest tech companies in India. And I valued it in Indian rupees. So I took, cash flows, growth rate, cost of capital, and I'd come up with a value of 614 rupees per share. And somebody in the audience said, what if you have a US-based investor looking at Infosys? I said, what should I care? He said, what if they would think in US dollars? I said, why does it make a difference? And they said, won't the value be different? So I decided to revalue Infosys in US dollars. And as I go from rupees to dollars, I want to start with the good news first, and then I'll give you the bad news. The good news when I go from Indian rupees to US dollars, my cost of capital all become lower. Tell me again why. Lower risk-free rates, not because of lower country risk premiums, because the country risk is still there, but I build off. So the good news is I have a lower cost of capital. But here's the bad news. When I do my growth rates and my returns on capital, I now have to do them in US dollars as well. That same inflation that hurt me in the cost of capital when I did things in rupees helped me by giving them a higher growth rate. So I adjusted the growth rate and the return on capital down to reflect the fact that this was a valuation in US dollars. So I have lower cost of capital, lower growth, lower return on capital. Bottom line is when I finished my valuation in US dollars, I got $12.79, which converted at the exchange rate on that day would have given me exactly 614 rupees. So for those of you valuing a company in another country, in another currency,
If you ever want to try and say, let me value the company in US dollars because I don't feel comfortable working with Vietnamese dong or Indonesian rupiah, try it. If nothing else, you see that it's not just the discount rate that changes, it's everything else about your valuation. Yes.
Bonus rate, did you get like from, for example, India, like average India?
No, just take your expected growth rate. And so if your expected growth rate in rupees is 16% and the inflation difference is roughly 3%, guess what I'm going to use in my dollar valuation?
You just like one.
That's exact. It's a differential inflation, right? It's not like my sources change. The company is different. I've just changed currencies. Yeah. Just adjust for the inflation. That's why it cancels out, right? Because both my numerator and my denominator get adjusted for the same thing in the same way. The effects cancel out.
Then, but also like, because that's like in the US, that's not.
No, no, this is a company that you can't move a company geographically by just changing currency. It's still the same company. All I'm doing when I'm changing currencies is changing my metric, my measurement mechanism. Now, that's why I keep you going back to the analogy of the temperature. Now, whether it's in Fahrenheit or Celsius, you can't make a place hotter or colder by just switching gauge. That's all currencies do. They just change your unit of measurement. You're not changing the company. You can't make a good company into a bad company by switching currencies. All you're doing is changing the unit of measurement. You don't seem convinced. Right? So what do you think you will lose when you go from a rupee valuation of Infosys to a dollar? Do you feel more comfortable, less risky when I do things in dollars? You got to let that go. Okay. Because in a sense, it's completely cosmetic, right? And you're not alone. There are people in Latin America who will dollarize their cash flows. Feel a lot. I've dollarized my Argentine cash flow. It's still in Argentina. You can dollarize everything, but if Argentina goes to hell in a handbasket, you're going to go to hell in a handbasket in dollar terms rather than peso terms. But I can't fix a company by switching currencies. All I'm doing is changing the measurement metric I'm using.
So what's the point to make it into value?
Pick one and do one. I wouldn't do both. But the only reason I did this was to show it doesn't make a difference. Okay. So if a company is good in rupee terms, it's undervalued in rupee terms, it'll be undervalued in dollars, it'll be undervalued in pesos, it'll be undervalued in yen, which is really good news if you think about it. Because if your valuation kept shifting depending on the currency used, how do you decide whether something is cheap or expensive? Yes.
Sectors are differently affected.
Oh yeah, it'll show up in your margins, right? But that has nothing to do with your currency choice. So if the dollar strengthens, affecting and lowers your margins, it's going to lower your margins whether you do things in rupee terms or in dollar terms, right? So whatever real operating effects there will be from currency movements will show up no matter what currency I value the company. So I'm not saying currencies don't affect your operations. Sometimes stronger dollar or weaker dollar can make your margins higher or lower. I'm saying if they affect your margins, they're going to affect it no matter what currency you do the valuation in, because you can't get differential effects. Talk about corporate governance. Now, clearly, again, this is not, the next three things I'm going to suggest are not just true for emerging market companies, but probably more likely to run into them with emerging market companies. There are emerging market companies who you worry about corporate governance. Why? Because unlike the US, where you can have a Nelson Peltz challenge, Bob Iger at Disney saying you got to change. If you took a Tencent, you say, I don't like the way Tencent is run. I'm going to change the way, good luck on that one, right? In many markets outside the US, it's very difficult to change bad management. And this is one of the things you worry about is if I have a company with bad corporate governance, should I be discounting the value of the company to reflect that bad governance? What do you think? You did the cash flows, right? So you know what you built in. So what's the essence of bad corporate governance? What does it do in a company? If you have a company that's badly managed or badly run with bad corporate governance, what happens? But managers all over the world make poor decisions, but with bad corporate governance, when they make poor decisions, you can't replace them. They can keep making poor decisions. You know how this shows up in your valuation? If you're a company with low margins, what do you do over time? You improve the margins. If a company that earns less than its cost of capital,
Over time, you assume they won't keep doing this stupid thing. And you do it because in the US, you assume that change is imminent, change will come. But if you're valuing a company with bad corporate governance, you know what can happen? They can take projects that earn less than the cost of capital and they can keep doing this forever. So if you've done your discounted cash flow valuation right, it should already be in there. So I'll give you an example. It's a company called Tube Investments. Company you probably haven't heard of. It's a South Indian company. It's been around a long time. It's a manufacturing company. And it's a company I valued, and this is a long time ago in 2000. The reason I value the company is the owners of the company, or the people who ran the company, the family group that ran the company, was very disappointed with the way the market was pricing them. They felt the market was being unfair, giving them too low a price. And I've known them for a long time. I've known them since I was a child. So they said, can you come in and value the company for us? Because we're convinced the market is getting this wrong. So stock was trading at about 100. So they're expecting to see like 150 value and affirmation that they were right. The market was big. So I came in and valued the company and it came up with a value of 63 rupees, which is not the direction they were hoping for. And they said, why is the value so low? So take a look at this valuation. And as I describe the valuation, you can probably very quickly spot what's making the value low. This is a company that's a money-making company. So it's not a money-losing company. It's reinvesting a lot of money, 60% of its after-tax operating income, and earning what looks like a pretty decent return on capital. But remember, this is 2000 and in Indian rupees, when the risk-free rate in rupees was 12%. So farther away, they were earning a 9.2% return on capital. So they're growing and taking projects that make a 9.2% return on capital. When you see the return capital, what's the number you automatically jump to decide whether the value is being created or destroyed? You compare it to the cost of capital. The cost of capital is 16.9%. Houston, we have a problem. You're growing and you're taking projects that destroy value. I didn't tell them that. I said it's 62 rupees. And they said, it must be because you're underestimating growth. I said, what do you want me to do? They said, that's 60% reinvestment rate. We can make it 80%. I said, I'll try that for you. So I tried it to 80%. You know what happened to my value per share? It went to 55 rupees. They said, this doesn't make sense. We're growing more. This is what happens when you define growing more as better than growing less. You know where the value is maximized? At a 0% reinvestment rate. Don't reinvest. Your value goes to 110 rupees. The reason I've left the return capital below the cost of capital, this was a family controlled company. There's zero chance of change. And what's the first step in fixing a problem? You got to admit there's a problem. They didn't even realize there was a problem. They said, we're making money. Why is this a problem? We're growing. What's it? No. But the problem was they were not looking at how they were growing, which is investing in projects that earn below the cost of capital. So some of you are valuing companies where you cannot change the management. The management is doing things that really don't make sense. You might want to leave it at that because you can't change the management. They don't borrow money because they don't like to borrow money. They take bad projects because they don't think it's a problem. They can keep doing this in perpetuity and that will affect your value per share. There's no discounting needed because it's already in your value. As I said, poor corporate governance is not just with emerging market companies. You're going to run into this, the Facebooks and the Googles of the world, right? Because why are you going to worry about bad corporate governance there? They're US-based companies, so what is it about the two companies that I just named that makes it very difficult for change to come? They're voting and non-voting shares. Mark Zuckerberg owns 57% of the voting shares of the votes with the 13% ownership he has. So this is not just emerging market companies. So if Facebook or Google ever drop below that line of being well managed, you can actually see investors saying, no change is going to happen in this company. Talk about cross holdings. Again, not just specific to emerging market companies, but you see more of them in Asia and Latin America because you have a lot of family group companies. And we talked about the challenges in valuing cross holdings. You ran into them in the quiz, right? Think of all the minority holdings, minority interest. Do I add? Do I subtract? But more critically, how do you value cross holdings when you don't have information? So the truth is with emerging market companies, especially family group companies, this becomes an issue. So again, I'll take an Indian example of 4 companies that are in the same family group. So you can't, I'm looking across the same There are 4 Tata companies: Tata Motors, Tata Steel, Tata Chemicals, and TCS. With each company, here's what I did. I did an intrinsic valuation of each company: FCF, the free cash flow of the firm, discount back at the cost of capital. I come up, see the blue portion? That's my intrinsic valuation. You see, what's the red portion? Those are my cross holdings added on top. Notice for Tata Motors, Tata Steel, and Tata Chemicals, how much of the value comes from those cross holdings? 30, 40, 45%. With Tata Consulting Services, it's a tiny portion. It's about 4.6%. Anybody want to try to guess why Tata Consult? If you're familiar with the Tata Group, you could probably help me out here. What is it about Tata Consulting Services that gives them a smaller percentage of cross holdings than the other 3 companies? How do you think these companies ended up with these cross holdings? Might have mentioned this when we talked about cross holdings. How do companies end up with these huge cross holdings?
We buy them.
That'd be very difficult. They're publicly traded companies. You have to pay market price, right? They're very expensive to do. So this must have been something they were endowed with before they even went public. 50 years ago, these were all private companies. In fact, there were only 3 companies in existence. So I'm going to kind of give away the answer. Tata Motors, Tata Steel, and Tata Chemicals have all been around for almost a century. So 50 years ago, they were all owned by the Tata family. They were not publicly traded. So if Tata Steel wanted to build a new plant and didn't have the money, guess what the family did? Tata Chemicals had a good year. They would go in and take, it's completely legal if you own all 3 companies to take the earnings out of one company and put it into the other company. And when you did that, the accounting transaction was you gave that Tata Motors a stake in Tata Steel because their profits. So it's an accounting transaction. As long as you owned all the companies, who cared? But 30 years ago, these companies started to go public. They went public, of course, all those cross holdings accumulated through history show up as cross holdings at these companies. Now, do you see why TCS is a far smaller percent? It's the youngest of the 4 companies. It was created after all the other companies went public. And once that happened, it becomes much more difficult to have this cross-holding culture. So it makes it easier then to value a TCS than a Tata Motors or a Tata Steel because you're not struggling with all of these cross-holdings. Finally, let's talk about truncation risk. Again, not just specific to emerging market companies, but we worry about them more, especially in some emerging markets. Truncation risk is catastrophic risk that can wipe out your company. I gave you the example of Blue Lagoon, the spa in Iceland, that's in the pathway of the lava flows from the volcano that has erupted in Iceland. Now, that was the basis for my catastrophic risk blog post. Somebody in Iceland wrote to me and said, can you tell me how to value Blue Lagoon Spa now that it's in the pathway? There's not a 100% chance it's going to get wiped out, but there is a significant chance that the company will not make it if the lava flows through. What are you going to do with the spa after lava has gone through the spa? That's a catastrophic risk. It's risk where if it happens, the value of the business is going to go to 0. It could be terrorism risk in a part of the world where things happen, your entire business can get burned down. And let's face it, in parts of the world where that risk is high, you can't just insure your company. You're beyond insurance. Or it could be nationalization risk, which is risk and less than it used to be, but in some parts of the world, your entire business could be taken over by the government. You could be given nothing or a fraction of the value. Notice what all these risks have in common. They're discrete risks. If they happen, there's a huge effect on value. If they don't, then you keep going as a going concern. Okay. Again, not just specific to emerging market companies, but so I'm going to give you an example of a company where I worried about this, not so much truncation risk, but discrete risk. You've all heard of Aramco, right? Aramco is a Saudi Arabian oil company. Okay? It's really not a company. It's a country. Why? Because if you look at the GDP for Saudi Arabia, almost 80% of the GDP comes from Aramco. And let's make it, it's really not even a country, it's a royal family. Basically, you've invested in an extension of the Saudi royal family when you invest in Aramco. Until 2019, you could not have invested in Aramco. It was privately owned by the royal family / the Saudi government. But in 2019, after 4 or 5 years of hemming and hawing, they finally went public. They floated only about 2 to 3% of their shares. So it wasn't as if they were selling 51%. because there's no way the Saudi family, royal family is giving away control. But they went. What made that IPO unique was the day they went public, they instantaneously became the most valuable company in the world in terms of market cap. Their market cap went in at 1.8 trillion. At that time, Apple's market cap, the largest market cap company, is 1.5 trillion. So I've never seen an IPO at the day after the IPO company. So I was fascinated. I wanted to value Aramco. It's actually a very easy company to value. It's 330 million barrels of oil under the sand, where it costs you about $6 per barrel to get the oil out, the lowest cost in the world. So the way I valued Aramco is I took the present value of the cash flows I would get as an equity investor from Aramco for the next 50 years. No terminal value. Because once your oil is out of the ground, what are you paying for? The present value of my free cash flow equity, and the free cash flow equity are immense. There's not much reinvestment needed. They have the endowment of the reserves. It costs almost nothing to get the oil out. So their free cash flow equity is expected to be 108 billion in that first year, 2020, growing at the inflation rate. What I got as my present value for the value of equity was about 1.65 billion. In fact, I tried dividend discount model, free cash flow equity model, they all came in with values 1.65 to 1.8 billion. So I finished the valuation and I said, I feel pretty comfortable with the valuation, but there's one thing I'm worried about. Do you see what the one thing is? Where does Aramco get all of its oil? From the Saudi sands, right? There is country risk here. And the problem is the way I've incorporated country risk into my cost of capital doesn't quite fully capture that risk. How do we bring country risk into our cost of capital? We look at the default risk in a country. What do you think Saudi Arabia's rating looks like, sovereign rating? It's like A+, AA. There's not much risk of default. But if you're investing in Saudi Arabia, your worry is not that they will default, it's that there will be some major shift that causes the Saudi royal family to get displaced and somebody else running the country. Hopefully not ISIS, but somewhere in the middle, right? So I had to think about what is the effect of that going to be on value. And here I'm going to make up stuff. I'm not a political analyst. I don't know what the chance of that happening, but it's definitely not zero. It's greater than zero. I attach a 20% chance that there would be a shift sometime in the next 50 years. To be honest, I think I'm underestimating the risk. It's probably higher than 20%, but let's say it's 20%. If that happens, what will happen? A new government will come in. They will now be the ones controlling how Aramco behaves. And the biggest driver of cash flows, if you're an equity investor in an oil company, is how much the government collects as royalties when you take oil out of the ground. Venezuela almost killed every foreign oil company invested in Venezuela by doubling the royalties overnight on oil taken out of the ground. Because when you double the royalties, there's less cash left over after those royalties. Here's what I assume. If the royal family continues to run Saudi Arabia, the value I get of 1.65 billion, I'm okay with. In the event that there is a change, I think that I will get about half the value. How do you come up with the half? Basically, I'm just slicing off 50% saying I'm going to be worth less. I attached an 80% chance to the status quo, 20% to regime change. My expected value is about 1.5 billion. Again, it's not something I would do in most valuations, but when you're worried about this kind of this discrete risk, it's better to do two valuations to factor that risk in. Which brings me to the last set of valuations, and I'm going to talk a little bit about valuing banks. I know some of you are valuing banks. I encourage you to use the dividend discount model. And that's a model I used to use. In fact, in all of my valuation books before 2008, you got to the chapter on valuing banks. It starts with a sentence that I've still not been able to live down. Chapter would say, valuing banks is easy. Okay? And I'll tell you the basis for that statement. I used to believe that banks were run by sensible people. And I used to believe that the regulatory overlay that they had on banks actually worked. Keywords I used to. You're saying, why does that matter? Because with banks, you have a problem. And here's what the problem is. You know how every valuation we've done so far has been based on free cash flows, right? Either to the firm or equity. Help me out again. How do we get to free cash flow? We start with earnings. Then we add depreciation, subtract CapEx, subtract change in working capital, we subtract out reinvestment. But that's how we get to free cash flows. When I ask you what the cash flow is for a bank, let's say, you can start with earnings, right? You can start with net income at least. Then ask you, what's your CapEx? What's CapEx for a bank? What's depreciation for a bank? What's change in working capital for a bank? And for the last century, when people have tried to value banks, they've got to the cash flow and say, I give up. So you know what investors and analysts have used to value banks? If you can't estimate the cash flows, what do you use? You look at the actual cash flows, which in the case of a bank is dividends. The dividend discount model this was the last sector where the dividend discount model hung in there because people could not estimate cash flows. But every question you ask about valuation, what are your cash flows? I don't know. What's the value of growth? I have no idea. How risky are you? The regulators take care of that. We just outsourced everything with banks until 2008. It worked really well. In fact, I'll show you what a typical dividend discount model would look like in a bank. It's an Egyptian bank called CIB. It's a pretty well-run bank. The way I estimated the value of the bank is I projected out expected dividends. How do you get expected dividends? You start by projecting expected earnings, and then you project out a payout ratio. How do you get the payout ratio? You look at growth and return equity. It's a very, very easily structured model. So I projected out payout ratios increasing over time as my growth rate decreased. I did everything in Egyptian pounds, which was a bit of a pain in the neck because the risk-free rate in Egyptian pounds was 10.5%. So that high risk-free rate gives me a high cost of equity. That's a killer, right? 23%. But that high risk-free rate goes with a high inflation rate, which also allows me to use a 10% growth in perpetuity, something you could never get away doing in a euro or a dollar valuation. But this is where inflation plays out in both places. In a dividend discount model, all you do is project dividends out per share. You discount them back today. The value per share that I got was 42 pounds per share. But you see where trust comes in? I'm assuming that the CIB bank managers are paying out what they can afford to in dividends, that they're not overpaying, underpaying. And I'm assuming the regulators are taking care of the risk. There are risks that I don't know about, the regulators have taken care of it. Whenever you use the dividend discount model, you're implicitly trusting managers to be sensible. And at least in the case of banks, the regulatory risk authorities are taking care of the fact that this bank can't become a very risky bank because they will shut it down. As I said, though, I've learned my lessons. For those of you valuing banks, or even if you're not valuing a bank, you pick up the annual report for a bank and you start reading it, you're going to recognize how quickly these banks become opaque. You know what I mean by opaque? You really don't get a sense of the risks they're facing. And for a century, we've accepted that opacity. The reason being, we made a Faustian bargain. You don't tell us much about you, but the regulatory authorities will take care of the risk, so we're okay with it. So banks are opaque and we've accepted this. So when we use the dividend discount model, we assume there aren't risks out there we don't know about, that the regulators would have stopped you from taking those risks. Second, if you look at those banks though, I mean, clearly that trust has been broken. This is why I said before 2008, I believe those, because 2008 was a moment of reckoning. We learned two things. One is we learned that banks were not run by very sensible people. How do we know? Because in 2009, when banks were basket cases, they continued to pay dividends, which you should be doing, but they chose to. And we also realized that the regulatory overlay had lots of holes in it. So in 2009, I started thinking about, I don't trust dividends, but I don't know how to compute free cash flows to equity. And first, with banks, always stay with equity because debt is raw material, not a source of capital. How do I come up with the free cash flow to equity for a bank? So let me try. Remember what I said about regulatory capital at the start of the class? It's what you need to have as a bank to keep operating. So if you need to invest in regulatory capital, it has to come out of your net income. You're saying, why would I need to invest in regulatory capital? If you're a high growth bank, you have no choice but to invest in regulatory capital because without that investment, you can't grow. If you're an undercapitalized bank, you have to invest in regulatory capital because if you don't do it, I'll shut you down. So what I'm going to do is I'm going to take the investment you have to make in regulatory capital and treat it like net capex. So I'm going to take your net income. I'm going to subtract out this investment in regulatory capital, and I'm going to come up with a version of free cash flow to equity that's unique to banks. So I'm replacing net capex and changing working capital with that investment in regulatory capital. So I'm going to give you an example. It's a valuation I did in 2016 of Deutsche Bank. You familiar with Deutsche Bank? In fact, the blog post I wrote about this valuation, the title I used was A Greek Tragedy at a German bank. And I used every word deliberately. You know why, right? The Germans like to point out how undisciplined the Greeks are and how they do things. And here you have the ultimate German institution looking like a Greek bank. By 2016, Deutsche Bank was all. I mean, when I tell stories about companies, I think about characters or something that I can use. So when I think about Netflix, I think of a hamster on a wheel. You have to keep producing content to get more subscribers and more content and more subscribers. When I think about Deutsche Bank, I think about that character in the horror movies that come out every Halloween, that teenager. The group of teenagers who go into a dark house where there's no power. What are you doing? They come up to the door to the basement and they can hear the sound of a chainsaw coming from the basement. And they open the door and actually go down into the basement. And then blood comes spurting out of the basement. So what the heck did you do? Deutsche Bank is like that character. By 2016, it kept finding chainsaws in basements and walking down to the chainsaws. Hey, look, a lot of blood now. In fact, the time that I valued this in 2016, the Department of Justice had fined Deutsche $10 billion for something that they did in 2008. Remember, when you have a big fine, it comes right out of your book equity and your regulatory capital. So it pushed the regulatory capital ratio down to 12.41%. So I'm going to accumulate all the trouble. So basically, you're an undercapitalized bank. You're a money-losing bank. Remember, every time you lose money, it comes out of your capital. And there was talk that had already started filling the air that Deutsche might have to go into receivership. What does that mean? That the German government would actually have to take over Deutsche. This happened actually after 2008 with the Royal Bank of Scotland. The government actually had to take it into receivership, wipe out the equity, and it came back public again. But with Deutsche, there was talk that the German government would have to do it. So I said, okay, you know what? I'm going to try to value Deutsche. I can't use the dividend discount model. Why? There are no dividends. And besides, this company is in deep trouble. So I decided to estimate the free cash flow equity. Let me take you through the process. I started by projecting out a recovery in the return equity, that over time they would manage to improve their return equity from the negative 13.7% you see up front to end up at 9.44%. That sounds awfully precise. You're saying, how do you come up with the 9.44%? That was my cost of equity in year 10. In my best case scenario, here's what I see Deutsche doing. At least making their cost of equity. Forget about value creation, but stop destroying value. As my return equity goes from negative to positive, my losses become profits. So that's good news. But to keep going as a bank, they can't keep the regulatory capital ratio at 12.41%. They've got to increase it because they're undercapitalized. So I picked the 75th percentile of Tier 1 capital ratios for all banks. Incidentally, if you have Capital IQ access, you can download that ratio for every bank so you can see what it looks like. So over time, that 12.41% has to become 15.67%. That leads to an increase in regulatory capital. They've got to add 6.6 billion. So each year, that becomes the equivalent of their net capex. So you take the net income, you subtract out the investment regulatory capital. I get a free cash flow equity of minus 11.7 billion next year. What does that mean? For Deutsche to become a going concern bank, it's got to raise fresh equity. Otherwise, they'll shut it down. And I'm factoring that into my valuation. Year 2, still negative. Year 3, still negative. Finally, in year 4, things start to turn around. My income is improved. My Tier 1 capital ratios come up. I discount those cash flows back at the cost of equity. The value per share that I get is $23. That is if Deutsche makes it as a going concern. Remember the Las Vegas Sands, the question we asked is what's the chance it will not make it? I'll tell you what Deutsche is going for it. It's really big. You heard of the term, too big to fail, right? And with banks, you can see why. If Deutsche fails, it's going to take every other bank down with it. So there's going to be an incentive to keep it going by giving it good terms. So the 10% failure risk might sound low, but if this had been a smaller bank, that number would have been 40 to 50% failure risk. But Deutsche was big enough that I put a 10% failure risk. That case, my equity is going to get wiped out. My expected value, that adjusting for that, is about $20.67. Stock was trading at $13.33. You don't ask me that question, right? Did I buy? I actually did, and I got lucky because about a year into my investment, Deutsche did it. You know what a rights offering is, where they basically offer fresh shares, and in which case you can sell your right back if you don't want to use it. I sold half of my rights back for my shares because I don't want more shares of Deutsche. I made my initial investment back. And the reason that was lucky is 2 years later, Deutsche found a fresh chainsaw in a basement. Another, so basically, they lurched from controversy to controversy, and stock dropped to $7 per share. This is a particularly difficult bank to value because it's money losing, it's undercapitalized. If you get a chance, take a look at my Citigroup valuation from last year after the SVB fiasco. I valued Citigroup. And I use the same approach, right? Citigroup is a well-capitalized bank. It has a low return on equity. I factored that in, but it's a well-capitalized bank. So it's a different way of thinking about free cash flow equity. One final point before we end for the day. Now, we talk about financial service companies as if they're all one big pile. But financial service companies can come in all forms, right? You just saw the value of a bank. Banks are one day. Insurance companies. How do insurance companies make money? If you had to value a pure insurance company, not a Berkshire Hathaway, how do you value? What do they get as revenues? The premiums you pay. What do they pay out? The claims you make. So what drives the success? What makes for a good insurance company? Well, whether they're good at assessing risk. Geico has been historically, because they're good at assessing risk, they charge high enough premiums. So insurance companies, to value an insurance company, you're going to forecast premiums, you're going to forecast claims, take the difference, that becomes your. How about a payment processing company? You know, payment processing companies, MasterCard, Visa, American Express, PayPal. How do they make money? The transactions that happen in your platform, and how do they make money off the transaction? They take a percentage. It's called a take rate. So when you use a MasterCard at the local store, you pay $100. $2 of that goes to MasterCard. 98 stays with the merchant. If you use an American Express, $3.50 goes to American Express. That's why a lot of stores don't accept American Express. It's a bigger slice goes out. What if you use PayPal? Same process. It's about 2.5%. What about Venmo? All of these, if there are transactions on the platform, a piece of it. No. So if I have to value a payment processing company, what would I have to do? I have to forecast the transactions you're going to have on your platform. I'll have to forecast the take rate you're going to have. And then estimate your revenues, earnings, cash flows. One of the biggest fiascos that I've ever done, I'll never be able to live it down. About 2 years ago, this company called Paytm, an Indian payment processor, went public. You know what every Indian and Chinese company going public has going for it? Lots of people on our platform. 330 million people on the platform. Mind-boggling. But remember, you measure in billions, 330 million is. So I valued it, and there had a lot of promise. Lots of people on the platform. So I projected out revenues based on that, and I was pretty upbeat about the potential revenues. But remember that the transactions happening is the first step. You got to look at a take rate. And here's where I made my fatal mistake. Their take rate when I valued them was 0.79%, which is, if you think about the MasterCard 3.5%, 4%, it's way below. And I assumed that over time that they would improve it to 2%. And for those of you who've tracked Paytm, it actually has gone in the other direction for two reasons. One is the people running this company seem to have no idea that the way you make money is by actually taking a percentage of the transaction, not encouraging people to use more transactions. I made the mistake of actually downloading the stupid app on my phone, even though I can't use it. And every day I would get 20 offerings. You can get this for free. Now I see why you have 330. You keep giving away everything for free. And the other was, in India, there is actually a payment system set up by the government called UPI, where if you transfer money, it's free. You're competing against a free payment processing system. It's very difficult to bring your take rate up. Put simply, a payment processing company in India, I don't think is ever going to have a take rate higher than 1%. Paytm, which I valued at 2,000 rupees, is now down to almost nothing because they've also had an accounting scandal, all kinds of messes.
But I think my fatal mistake was in the take rate. So let's file that away. When we come back on Wednesday, we will finish this package. So if you can, download packet 2 and bring it with you. We will start on packet 2. Yes.
I have a question. We talked about that being a double-edged sword, increasing debt ratio. And specifically, I don't know if you remember our conversation about my company having LLCs with operating leases. I decided not to count it as debt, but when I was going to count it as debt, even if I were to count it as debt, then something like say like reputation risk or something like that, it's not the same level of risk as default.
It's probably more like secure debt against an individual asset rather than against general obligations, right?
So when you're levering data, you do it the same way.
Still do it because your earnings, because we lever baited, not to failure, default risk. We lever baited because your earnings to equity investors becomes more volatile, right? So when I take on leases, even if they don't have the same effect on default risk as traditional debt, they make my equity earnings more volatile because I've got to make those lease payments first before I collect my equity earnings, right? So from that perspective, the levered beta effect will still be there. The default risk effect might be small. So you have two companies, one with traditional debt and the other with lease debt. They might have exactly the same amount of debt, but the company with the least debt will have a higher rating and a lower cost of debt because the default rate might be lesser with the least debt because of the way you structure it.
But the levered beta.
And levered beta impact would still be the same because it captures the fact that your equity earnings. So the levered beta effect has nothing to do with default rate. You've got everything to do with the volatility you create in equity earnings because you've created this commitment, a contractual commitment to make a payment to somebody.
And then another question, you talked about briefly profits.
Yeah.
Are we gonna like work with that well?
No, because I think that would require almost, we haven't done multiple regression. So we will talk about some aspects of multiple regression when we do prices, the tool we're going to use. But unfortunately, that would require a dive into statistics that we don't have the time to do. But but there's so much, there's stuff online you can use. It's not difficult, especially in today's day and age. We have statistics package. Not can you do a probit, it's can you read a probit, right? So SPSS, I don't think Minitab does it, but SPSS, SAS, all these programs that you can get for your PC or Mac. Most of those programs will do a probit for you. Right. But the question is, can you read that probit? So if you're going to pick up a book on probits, it's about how to read a probit rather than how to do a probit. Unfortunately, many of the hardcore statistics books will spend 100 pages on how you do a probit. That's overkill. You don't need that, but you need a book basically. So if you're going to get a book on how to read statistical output rather than how to do a multiple regression.
And are there any out there already for like bankruptcy stuff?
You know what I like? I actually like the SPSS actually comes with a manual that comes with the program itself, which actually does in very simple terms explains the outputs. It actually is tied to the output, and you can say, okay, that's the number. So it's actually nice and compact and doesn't dive into things that you don't care about if you're not actually doing it from scratch. So see if you can get the SPSS manual. You can get it on Amazon, you can get it at the bookstore used to carry it, and know they will still carry it.
Right. Thank you. And then last question.
Yeah.
If I got a perfect score in the first two quizzes, is there any reason to take the third?
The only reason is, remember, if you miss the third quiz, you get the average score, not just across your first two quizzes, but across all your exams. So if you crash and burn on the final,
All right, so that makes sense. All right.
it'll then make it a 40% final. So the final then carries a weight that's disproportionate because it then spills over.
Right. All right. Got it.
That's the only reason to do it. But if you feel comfortable missing it, I don't have a problem with it, but that's the downside.
All right. Thank you.
Yes. Good.
What's the particular questions like that they want to ask you? What are the office hours?
Between 12 and 1 on Monday and Wednesday.
And one thing, because I'm valuing a company called Sofa,
Uh-huh.
and like I was like very confused about multiple things when I was valuing them, especially like multiple you can write down, but they have so much like loan held for sale, and its value like decreasing. And the company's
What are they, a financial service company?
exactly, they're a financial services company,
Right.
but they're also a bank. They're acting as a bank, but they get like 65% of their revenue with lending and like financial services. I was like first confused, like what model should I put in? But since the
It has to be dividend.
has to be.
You can't do a free cash flow firm model. So already that's cut out. You can do a dividend discount model, or you can do a free cash or equity model. Do a free cash or equity model, you got to understand financial service companies. So if you're not comfortable with regulatory capital and financial service companies, you're going to get in trouble, not because they're doing something weird, but because you don't understand how banks work and how regulatory capital requirements are set.
Don't you think it will be opportunity for me to learn more about it?
But you'll have to learn about banks and how they're regulated, what regulatory capital looks like, right? There's no way around it. If you want to really value it, you got to expend the resource. I don't know how much time you have in the remaining 6 weeks. It's got to be, do you have enough time? But that will take time, much more time than learning about a business that doesn't have that kind of institutional knowledge that can affect value.
I'm also taking Professor Masant's class systematic investing, so I have a project as well.
Yeah.
So it will be, and I was like, I want to ask you like the last thing you said about the India UPI, because I've been like, I'm from Pakistan, I've been following like Indian market like quite often, and you know this Bharat Pay company, right?
Right.
Sorry.
What about it?
So like this company get much popularity, and then this guy Ashni Global come in, and the whole story he always made like, okay, they were Paytm but always asking like 2% right now, 2% change, and the guy come in and they say like, I put the QR code in every shop, and that gave me like the whole new market and everything. But I'm trying to understand the consumer shift. You said like India already had a UPI, so how this become successful, and what's the future for like this company, because you are trying to
Paytm is probably sunk if it doesn't figure out a way to increase its take rate.
Bharat Pay is like going good.
What do you mean going good?
Well, like
It's growing, but is it making money? Paytm was going great 3 years ago when it went public. By going good, you mean they're growing fast, they have a lot of customers? Of course you are going to have a lot of customers if you give things away for free. But going good requires that you increase your take rate so that you're making money. I'm not familiar enough with the financials to see if they're making money, but I'd be very surprised if they are.
Because I'm not even sure about that, so I'll take a look.
Okay.
Thank you, Russell.
You're welcome. Take care.
This is a quick question. So I went to the review session last
Mhm.
week
Yeah.
with Deep and Jake. And I'm valuing a company like Nintendo in Japan.
Mhm.
And one of the points that I asked him about was like, how do you treat the operating lease? Because like in the note it said like, oh, it's treated as like in the.
How big is it? Why? I mean, with the Nintendo, it's going to be
Yeah.
a tiny number. Why are you? It's exercising
Yeah.
so much of your resources
Yeah,
doing
'cause,
it? Convert it to that. Don't convert to that. It's
Right.
going to be second decimal point effect in value, right?
Right, because when I talked to Deep, he mentioned that in like traditionally Japanese companies like operating lease are underestimated, and he said that you should like refer to Professor Promoter's like past resources and how he valued the Japanese companies and how he treats the operating leases.
But in this company, leases, I mean, I've valued Nintendo multiple times.
Right.
Leases don't even enter my top 20 things to worry about. So
Okay.
if you want to capitalize leases, do so. It's
Right.
not different for a Japanese company or a US company. You take the lease commitments, you discount them back at a pre-tax cost of debt.
Okay.
You're done. In the
Okay.
case of Nintendo, it's not going to shift the needle very much.
Okay, I was just like trying to get all the nitty gritty.
Yeah, but the same the process for converting leases is exactly the same around the world.
Right.
You know, there's no difference between Japanese, US, European, Indian. They all
Yeah.
you capitalize leases exactly the same
Yeah.
way.
It was just in the process when I was trying to capitalize it back. How they reported it was they provided me the sum of all the operating leases from year 2 and beyond as
Yeah,
one
you
value.
just have to make it, just take it, treat it as an annuity beyond year 2,
Okay.
like
Just
arbitrary
estimate it
life.
as
and
you can.
you know, just move on, it's not.
Okay. All right, sounds good. Thank
Okay.
you.
Master,
Yes,
I'm so sorry, but I just realized I didn't input the share number in the valuation.
who you value?
For sure, the insurance. So I'm
That's my
using the-
fault, because the model that I created just valued the equity, just add a extra share count, convert the value per share.
No, but so
Just divide the value of equity that you get there
yeah.
by the number of shares.
Okay, so just add one.
All you need to add is add an
Oh.
extra row and then put in a price per share so you can have the comparison all on one page.
And also, they have like two kind of shares. It's like the
Doesn't matter.
A and a B.
Yeah.
Doesn't matter. Okay, great.
Yeah.
Thank you.
Okay,
Then I just like reply.
Mhm. Yep.
I
Hi.
have a question for
Mhm.
the dad that you're estimating.
Yeah.
Like why, like, I mean, for a distressed company, why don't you just use the liquidation value
of what?
of all of the,
What is it? Where do you get the liquidation value?
like, I mean, if you think about, like, just based on your liquidity right, for account receivable, like maybe you can get 80%
Or what?
of its book value. I mean,
But by assuming book value is close to, I'm not arguing. So you can
Uh-huh.
get a liquidation value, but that's what you get in failure.
but isn't that is the fair value that you will got in the end? Like if
No,
you're
that
really
your equity could be worth nothing if you get the liquidation value in most companies. Right? And if the fair company never liquidates, why would the liquidation value even come into play? Now, going concern, the liquidation value never comes into play. You still have to attach probabilities that you liquidate, right? The liquidation value comes into play only if you're forced to liquidate.
But now before really going bankrupt, so that's what we're.
But there's a probability that'll happen. You can have that
Ah.
and estimate the liquidation value for that probability, but there'll be a probability that they will not liquidate and continue as a going concern. So you still have to do the DCF, right?
Then, oh yeah, I got it. Thank you.
Okay.
Oh, and also,
Yep.
like for the project that I'm doing, I'm valuing the Walmart.
Mhm.
And the problem that I met is when I'm valuing the ERP, I need to look at the operating regions, right? But in Walmart's 10K, it didn't show any like revenue distribution over different regions. It just show like the Walmart in the US, the Walmart International.
Just put the rest of the world on it and move on.
But also it brings out the Sam's Club
Yeah,
separately.
Again, it doesn't make much. Your equity risk premium, if you put in the global equity risk premium, for the
Yeah.
rest of the world, it's going to be like 0.3, 0.0. It's not
Uh,
worth the trouble, right?
Okay.
This is
So I
not
just
the,
combine.
just
them.
combine it, just use a global risk premium first.
Okay.
Okay.
Thank you.
Hi.
Hi, Professor.
Hi.
I have a question about, because on the previous page of your PowerPoint
Yeah.
about Saudi Arabia, that
Yeah.
one, and many other examples before. So you say 80% of the probability that the politics stay the same,
Mhm.
and 50% if the DCF is
Mhm.
going to shrink to 50%. So I think those numbers are really arbitrary. And like if I say 30%
Yeah.
for this
So
one, and the
basically,
number
no,
is
no, but
gonna be
it's not
different.
arbitrary. The more pessimistic you are about Saudi Arabia, the less likely you're going to, why is that arbitrary?
Yeah,
You're
but-
saying an investment in Aramco is a bet on Saudi Arabia as a country and the Saudi royal family. That is the truth.
Yeah.
That's what you're capturing in the probabilities. So that's not arbitrary. That is the basis for your investing.
Oh,
If you're more optimistic that the Saudi royal family will stay in place, you're more likely to be an investor in Aramco in the first place.
okay.
If you're more pessimistic, so it's not arbitrary. It's at the core of why you would invest in an Aramco in the first place.
Okay. But if I think that like Saudi Arabia has a little chance of being
If you think this
transformed
is zero, you'd be willing to pay more. So you'd be buying
Well,
shares from me.
Yeah, but if I change the 20% to 30%.
But that
I
doesn't
still
come out of
feel
nowhere.
the
It's what
same.
you think about, feel the same about what.
I have the same attitude towards Saudi Arabia.
But you'll be willing to
20%
pay,
is
but
30.
you'll be willing to pay a lower value then, right? The
Okay.
higher this percentage becomes, the lower the expected value
Yeah.
will become. So you would be buying fewer shares of
Yeah.
Aramco. If I made this 80% and this 20%, you'd be willing to pay only like 900 billion. You'd never buy Aramco. You'll always look overvalued to you. But
Yeah.
rather than think of it as arbitrary, think of it as the center that will drive whether you invest in Aramco. It's what you think about Saudi Arabia as a country politically will be the key driver in whether you invest in Aramco in the first place.
But
The same
well,
reason,
into
if I'm investing in Taiwan Semiconductors, do I care about what happens to Taiwan? Absolutely.
Yeah.
Right? If I think there's a 90% chance that Taiwan will become part of China and Taiwan's, I'm not going to buy Taiwan Semiconductors, right? It's not arbitrary. It reflects the fact that that is the risk I'm worried about.
And another question
Mhm.
is, I wonder if you have any research that you're conducting, and
I don't
we're
do
really
research. I'm a
interested.
dabbler, right? I hardly ever do research. I just write about things that interest me and then move on.
But
Okay.
we're really interested being your assistant. But if you don't have any research, we're gonna.
I don't do, see, unfortunately, I don't do research, so I don't use assistants, right? So I basically write about whatever interests me in a week and then I move to another topic. And so my research, if you can call it that, is just writing about things that interest me. whether it's a volcano in Iceland one week and Aramco the following week, and Tesla the week after. I keep moving from topic to topic. Then I lose interest and I move to something else. So unfortunately, I've never used research assistants because I don't do conventional research. A lot of people here do though. So they need people who collect data. I don't do that kind of research. Right?
So like Jack or TA is
Mm.
your most students, right?
Mhm.
But we've been thinking about that as well, but we will go back to Shanghai because we are from the Shanghai
Right.
next semester, and this is also impossible for us. We're just thinking like if there's a way for us to like continue learning from you or
Oh, you can keep learning, right?
From
You
the
can
UT
bounce me
webinars.
off and you can email me if you have questions. You can value a company if you get stuck. The class ends. I'm still around, so you can still do that.
Thank you so
Yeah.
much. And another stupid question is,
Mhm.
for the quiz 3, if we got like 10 for previous 2, but does this mean like the quiz 3 will be?
No, because remember the score and that quiz. So basically, if you miss quiz 3, your final will become 40%.
Oh,
So it doesn't re-weight the first 2 quizzes. It just means the final will be 40%, which means if you do badly on the final, it'll have a disproportionately large impact. So that's the risk you run if you miss quiz 3.
no, it's like.
But same thing applies, right? If you do badly on the quiz 3, I replace the average score across your remaining exams.
Oh, it doesn't mean
And-
that's the first 2. Okay.
No, you won't get a 10 on the third quiz. So if your final is 24 or 21 out of 30, that's going to then populate your third quiz. It'll get replaced with the average score across everything else.
Thank you so much.
Oh,
for
okay.
that.
All right,
Yeah.
got it.
Okay,
Thank you.
take care.